Bem-vindos ao terceiro webinar da série Reforma Tributária, o que podemos aprender com a experiência internacional do VAT ou IBS no Brasil, do Núcleo de Estudos Fiscais da Escola de Direito da Fundação Getúlio Vargas. Sou Eurico Santi, professor da FGV Direito SP e coordeno o Núcleo de Estudos Fiscais juntamente com o professor Isaías Coelho. Este evento está sendo transmitido pelo canal da escola, no YouTube, e pelo Zoom, para mais de 500 participantes com tradução simultânea inglês-português e português-inglês. Para isso, basta acionar na barra de ferramentas o botão PT. As opiniões expostas neste evento não se confundem com as posições institucionais da Fundação Getúlio Vargas. Reiteramos também que todos aqui presentes concordam em participar desse evento de forma espontânea e, com isso, autorizam o uso de sua imagem para essa transmissão, que ficará disponível posteriormente nos canais oficiais da FGV, com letreiros de tradução. Este evento de hoje também é coordenado pela professora Melina Rocha, da York University. Bom dia, Melina. E pela professora Rita de Feria, professora catedrática da Universidade de Leeds, no Reino Unido, conhecida no Brasil e aqui em Trancoso, na Bahia, como Rita de Feria, padroeira da Reforma Tributária do Brasil. Nossas especiais boas-vindas ao professor Joachim English. Bom dia, professor, da Universidade de Münster, que será apresentado pela professora Rita de Feria. Estamos aguardando aí a oportuna entrada do professor Isaías Coelho, que não pôde estar conosco nessa abertura, mas deve aparecer no decorrer do evento. Com a palavra, a Melina Rocha para fazer uma introdução e falar sobre essa nossa série de eventos. Melina, por favor.
Thank you very much. Good morning, everyone. So it's a pleasure to receive today Professor Joachim English to talk about VAT and digital supplies. Professor Rita will present you. I just want to say that we have two more webinars next week with Professor Rita de Feria presenting the progressive VAT. So we are all waiting for this presentation. And also on July 7th, Emily Satterwhite here from the University of Toronto. She will speak about tax signaling. So we have two more webinars next Wednesday and the Wednesday after next week. And I hope you can join us as well. So Professor Rita, please.
Hello, everyone. I'm going to speak in English because of the YouTube transmission. So it's up to me now to introduce our guest, Professor Joachim English, who is a professor at the University of Münster. And it's no exaggeration, but one of the most prominent professors of tax law in Europe. We have been friends for a long time. We were introduced, I think, maybe 15, 17 years ago, something like that, by another German professor, Professor Wolfgang Schön. And I remember Professor Schön came to me and said, I have someone to introduce to you. He's a rising star in European tax law. And he introduced Joachim to me, and he was right, of course. He is an extremely preeminent writer. He writes both in English and in German. He writes on VAT, which is the topic of his talk today, but he writes also on other areas of the income tax, personal income tax, corporate income tax. So he's a very prolific writer. He writes a lot a year. At the moment, he has a PEP topic, which is the minimum corporate tax rate, which, as you have all seen, has exploded at international level. But he was there together with another friend of ours, Johannes Becker. The two of them have been writing about this topic before it was sexy. So now the two of them are the hottest thing in town at European level. They are guiding European negotiations on the corporate minimum tax rate. I'm going to tell just a personal story about Joachim, because we have worked together for such a long time. We have a lot of stories, both good, some a bit more sad, some comical, some that I cannot tell here at all. But I will tell a personal story that has to do with Brazil. So this is the thing. Joachim, or as I often call him, o Joaquim, is the person responsible for me being here today. Many years ago, I was commenting with him how I received invitations all over the world to speak in various venues, but I didn't have the fortune of being invited to speak in Brazil or have any contact with the academic community in Brazil. He, on the other hand, was invited almost every week to come to speak in Brazil. And he was already a very well-known person. So I was commenting that with him, and he said something along the lines, don't worry, leave it with me. And a few months later, I received an email from Professor Heleno Torres, inviting me to come to give a talk at São Paulo University at a conference. And of course, he didn't mention Joachim in the email, but I can only assume that Joachim used his powers of persuasion that only a German law professor has to convince.
Not much was needed.
He's just being kind. So to convince Heleno Torres to invite me, and the rest is history. I came to the talk. If I remember correctly, Joachim actually told me off during that event. Told me that that was getting on his nerves, and of course he was right. And we, as friends do, hugged it out. I apologized to him, and basically that was the beginning. In that presentation, there were other people, including Eurico's great friend Paul Weirish, who then mentioned me to Eurico. And if it wasn't for that, sequence of events, I would not be involved on the Brazilian tax reform. I would not have spoken in Congress, and I would not be organizing these seminars here today. So for good or for bad, so if you're unhappy about my participation, for bad, if you're happy, for good, Joachim English is the person responsible for me being here today and for my participation in the process of the Brazilian tax reform. And with that, I give the floor to my great friend, the only one, or one of the few people that can tell me off without me being annoyed, Joachim English. The floor is yours.
Yeah, it's almost like a marriage, huh, Rita? A good long marriage. No, thank you very much for your very warm words and for your welcome. And I'm so happy that you actually invited me to this seminar. So now it's up to me to say thank you for having me here. It's a great honor and a great pleasure. And indeed, I have close ties to Brazil since 2007, I think, when I first came, and I found it extremely easy, just visiting a couple of conferences, making contacts, getting in touch with people. There's a lot of mutual interest in exchanging academic views. So I'm always happy to come. Next time I'll come will be September, actually. So I'm very much looking forward to this. And so I'm really happy that I can contribute a little bit to the debate in Brazil right now by giving this little presentation here, which I'm about to start. Let's see whether it works. Hopefully it does. I think so. So I'm gonna present today on VAT and digital supplies, as I have been requested to do. And let's first maybe delineate a little bit what we're actually going to talk about. So what do I mean by digital supplies? What will be the topic of my talk, so to speak? Well, it's a subset. It's part of what you could call e-commerce. And in my view, it's characterized by essentially two, maybe three features. First of all, we have supplier owing an intangible result of his or her performance. Usually the underlying transaction is concluded online already through a mobile device nowadays often, or through a fixed device still. and then quintessentially the supply is actually rendered or performed also via the internet, essentially only via the internet or a similar electronic network. And that makes it different, say, from a haircut, which is also, you know, a supply with an intangible result to some degree, but it's not rendered via the internet, at least not yet. And that to me is what we're talking about, a digital supply, meaning you have an intangible result of performance, and that reaches the consumer exclusively via the internet. Now, in some legal definitions of VAT legislation, you also find the additional condition or restriction or a definition element that there should be a high degree of automation. Well, that is then part of the legal definition of that particular legislation, but I think it should not limit, you know, the topic of our analysis, because that's not necessarily a feature, I think, of a digital supply. So if you think, for example, of online teaching, so remote teaching, that is not necessarily fully automated if it's not just a video, but still, you know, it's an intangible supply. You get an intangible result, and it's supplied via the internet. So in my view, that is something that figures also under digital supply. Now, why is that a peculiar category of supplies, and why are we talking about this today? What are the challenges associated, which we'll have a look at a bit closer next slide? Well, there's 2 or 3 typical features that make this special from a VAT perspective. You usually have a high volume, low value trade. So there's a lot of transactions going on, but they have small value. So we're talking about things like downloading software, downloading maybe ringtunes, about things like streaming for a relatively low charge, online gaming, well, then a bit higher sums may be involved, online porn, whatever. Whenever there is this kind of supply, it's digital, and again, often it is low value but high volume. And because it's rendered via the internet, and that's really the crucial aspect that creates most of the challenges, there is no need for the supplier to be physically present at the place where the supply is received. So often we have a cross-border supply without the physical presence of the supplier, so an import of the supply. And that creates enforcement issues, in particular because there is no one on the territory of the country where the supply is received that can be held accountable if this person does not file a VAT return or pay the VAT due so easily, because you just can't get physically a hold of him or her on your territory. Now, having said that, let's maybe look in a bit more structured way at the challenges associated specifically with imports of such digital supplies. Oh, by the way, if anybody has a question, I guess I can pop up the chat. And if no, I don't see the chat right now. Why not, actually? Well, no, I don't really see the chat. So
Joachim, I think Melina will collect any questions.
Okay.
Because
Okay.
she's managing the Q&A. So if anyone has questions, she will give you the questions at the end.
Okay, fine. Good. So what are the challenges then? First, you know, if we're talking about imports that we want to tax possibly, we need to establish taxable nexus. We need to realize the destination principle. I'll talk about that a bit more in a few slides. And that means we need to have proxies based on which we decide on which circumstances we consider that a digital supply has been consumed locally in the territory, say, of Brazil. And these proxies need to be conceptually right, so they should reflect, to the extent possible, the destination principle, the overarching principle for allocation of taxing rights on the VAT. And they should also be technically adequate, that is, they should be feasible to handle for the suppliers when they render their online supply. And we're going to talk about that as the first of the 3 possible challenges or aspects of digital supplies. The second point is that once we have determined that a supply is an import into the territory of the country, the question arises, well, how do we classify it? In particular, is that a service or something else? And I'll talk about that because I know there's some special interest in that for reasons of fiscal federalism in Brazil. And then other questions such as, should there be special treatment in terms of rates or in terms of thresholds or other aspects? And finally, the most crucial aspect is, well, it could be nice, you know, to have a good looking system by which it's clear under which conditions and at which terms we tax those imports, but how do you actually collect the VAT? How do you control that the VAT liability is reported and also fulfilled if, as said, the supplier is not physically present in your country? And that is the issue of enforcement jurisdiction, which is in principle strictly territorial, and how to overcome this obstacle. And that will be the third part of my talk. Okay, let's maybe before we go into the first aspect, how to determine whether it's connected to our territory, let's maybe ask the question, why should we even bother? You know, whenever there's challenges, a rational person should ask, why should I face those challenges? You know, I might just, you know, leave them aside and then invest my energy in something else. And the same might be true for the legislator or treasury. And the answer is here basically for three reasons. First, there's quite a bit of revenue involved if you tax that properly. So, for example, in the European Union, according to the figures I've seen, we can assume that even what is collected, and as I shall say later, some is maybe not collected because there is a VAT gap, but just looking at what is actually collected in terms of tax on imports of digital supplies, we're talking about roughly 1.5% of overall VAT revenue in the EU 27. And VAT being, well, the budget workhorse, so to speak, a real big revenue raiser, that is a lot of money, even though it's only 0.5% of overall VAT revenue. Plus, the sector is growing. So according to IMF data, for example, in the 22 countries that they surveyed, online supplies of digital products, if you like, has risen by 60% in just about 10 years only. So there's rapid growth, and that means the revenue aspect becomes more important. Plus the level playing field becomes more important, and that's maybe even more important from the business perspective, because if you don't tax these kind of suppliers, at least not when they're imported, when they're supplied cross-border, you disadvantage your own local businesses, either the traditional businesses rendering similar supplies offline or domestic suppliers rendering similar services as digital services, and that can really distort competition to a great degree. And since we're talking about low value, margins are often small, and that means that if you don't tax certain competitors, you will basically force your own domestic businesses out of business, possibly. And finally, there is a tax fairness aspect that is sometimes overlooked. If you assume, as is the case in most jurisdictions, that digital services, in particular, just as services in general, however, are predominantly consumed in terms of volume involved by the better off, that means if you tax that, you have a certain element of indirect progressivity in your VAT. And so for distributional reasons, you should also try to tax this. Plus, quite pragmatically, more than 80 jurisdictions are already levying VAT on imported digital supplies, including the countries where I come from, so the EU 27 member states. And that means there is a treasure trove of experience already, because that started basically 6-7 years ago in most continents. And so we have quite some experience already. There's best practices emerging, and we can kind of pick if we are in the position to now design a new system or improve the current one. There is no need, as I said here, to reinvent the wheel. We can look at what others did, how they fared with that. And I will try to give some comparative legal analysis throughout my presentation in terms of good practices and not so good practices. Plus, we have extensive guidance by the OECD. There is, for example, the OECD Ottawa Framework Conditions from 1998, a still useful material, which I'm going to comment about a bit more in depth in a couple of slides. There is, of course, the 2016 VAT GST guidelines, which extensively deal with this issue. There is more recent material on how to implement these guidelines, on how to involve platforms from 2019. And there is IMF guidance to some extent, and also regional bodies such as ATAF for Africa, or of course the EU Commission have given additional explanations. So we can build on that. Plus, yeah, well, what else do you want to do? Not tax at all. That's for the reasons above, not a really convincing alternative, and also will probably not please the general public, which might perceive it as unfair. And the alternatives are not really more promising. So there's, of course, the digital services tax, which we now see proliferating in many countries worldwide, especially in the EU, but also outside. And you might say, well, if I have a different digital service tax and I basically tax automated digital services, why should I still have a VAT on this? Because usually the DST is also based on revenue and not on profits. But you have the same issues, the same challenges, more or less. You need to establish nexus based on some connecting factor that represents typically where those services are consumed. You have the same enforcement issues. It's not surprised that the suggestions on how to enforce the DST take the VAT as a model. And you have additional disadvantages in my view. So you have cascading when it's B2B, because the DST, there is no input DST claim foreseen. There is the question of tax treaty compatibility, because it's disputed whether it's maybe not also still the direct tax on those businesses that offer those services. Plus you get a trade conflict maybe with the US, because they feel you target their US companies. US doesn't mind so much if you have a high threshold on de facto tax predominantly imports from the United States under VAT, because the US kind of has accepted that other countries have a VAT, they don't. But they don't like this new type of tax. And we've seen both administrations, Trump and also Biden, still pursuing, countermeasures against those DSTs. And so it's not something that is a better option, and especially not, of course, if we get the political agreement in July, which basically might require to roll back those DSTs if we get Pillar 1 instead. So for all of the reasons, I think there's a good reason to pursue the VAT avenue regarding digital supplies in principle. Now the question then is how to do that. If we want to do it, and if we think we should do that, as I do, the question, of course, is how. And I'd first like to remind us of some basic principles that I'll come back to throughout my presentation, which should guide the design of the VAT also, not only, but also in particular when it comes to taxing imported digital supplies. And these are basically the Ottawa Taxation Framework Principles devised by the OECD Council of Ministers in 1998, but still valid guidance according to the 2016 guidelines that I just mentioned. This is still the state of the art. It's generally accepted. The guidelines that state so have been endorsed by more than 100 countries. So this is really generally accepted principles on how to design e-commerce rules for goods, but also for digital supplies in a VAT. And basically, we should ensure that there is neutrality. So in particular, equal taxation for competing supplies, online, offline, different forms of online supplies to the extent that they compete, and for different distribution channels, so the internet or other distribution channels. There's the principle of efficiency. So you should try to keep compliance and administrative costs as low as possible. And that's particularly relevant in the context of digital supplies. As I said, because here we have low value, often we have therefore also low margins. And so if compliance costs are too high, or if administrative costs are too high, they are not proportionate anymore to the margins of the businesses or to the revenue of the treasury. There needs to be tax certainty, meaning clear rules, easy to understand rules and simplicity. The design should be effective and should ensure fairness, meaning in particular that it should be robust against tax evasion and avoidance. And I know that Rita will like to hear that because it's one of her key research topics on how to design a VAT that has this characteristic. And finally, very important, of course, when we're talking about digital supplies, it should be flexible in the sense that it should be future-proof. It should be easily adaptable to evolving business models. Now, all of these are principles. They are not dogmas. So, of course, it's possible to deviate. The system doesn't have to be perfectly neutral if there is a good reason to have a little bit less neutrality, if that, for example, increases efficiency. But in any event, such deviations should be limited, they should be justified, and they should be proportionate. Okay, so on these theoretical foundations, let's now look at the practical issues. And the first issue being how to determine place of taxation, how to determine whether there is an import of a digital supply that has sufficient connection to the territory of, say, Brazil to justify its taxation there under the VAT. Well, I think I can do that rather fast. The principle of taxation at destination is the generally acknowledged principle for international allocation of taxing rights under VAT. We find it in the OECD VAT GST guidelines that have been endorsed, as I said, by more than 100 jurisdictions at a global forum 2015. It's general practice globally, in particular, also in the EU, at least since 2008, when we had a so-called VAT package, which massively shifted taxation of services from origin principle to destination principle. And also, at least under real life conditions, there's very good reasons actually to tax at destination. The more academically oriented among you might know that economists claim that under perfect conditions, so no reduced rates, full flexibility of exchange rates and so forth, origin taxation and destination taxation is basically equivalent. But in real life, we don't have those perfect conditions. Plus, in public perception, it looks odd if, imports don't have incurred a formal VAT burden. And so for all those reasons, in practice, we should indeed stick to the destination principle. And I don't think I need to go in depth here, and I also don't think I have the time. But there's good reasons that we have that as the fundamental principle. And that means we need to determine the place of consumption meaning final consumption by those who are supposed to bear the VAT, and these are the final consumers, not the intermediate businesses in the value chain. And where this final consumption occurs, this is where a supply should ideally be taxed. Now, the problem is when we talk about digital supplies under VAT, we're talking of a supply of intangibles, plus it is an indirect tax that we're talking about. So since it's intangible, it's often not so clear where a supply will be used. For example, if you have a ringtone on your phone and you take your phone with you on your traveling, well, you use that ringtone in very different places, and it's hard to track that. Plus, in particular, it's extremely hard, or rather impossible to know for the supplier. And it's the supplier, in principle, that is liable to pay the tax, and he or she can't really know where you use the intangible that was made disposable to you as a customer. And so, therefore, we need proxies, especially in B2B, where we don't even know where the final customer might eventually be. So we need to have criteria, connecting factors, as I write here, that give a reasonable indication with reasonable probability of where final consumption might actually occur. We don't know, typically, at least not in case of digital supplies, where final consumption actually occurs, but then we need proxies, indicators, connecting factors that give us a reasonable degree of probability of where it will be, and that we take as a factor to tax. And usually we do that for certain categories of supplies, for example, electronic supplies. So that was also quite theoretical. Now it gets a bit more concrete. What does the OECD suggest regarding remotely supplied services or intangibles? And that's basically what we're talking about when we're talking about digital supplies here. Well, they suggest to distinguish between B2B and B2C. When it comes to B2B, it should be the place of business where the taxable supply should occur, or where the place of taxation should be, or if there is an establishment of the business, then the local use in this establishment should determine the place of taxation. And in case of a final consumer being the direct customer of the supplier, it should be the place of his or her residence in case of a remote supply. Now, this is indeed also predominant practice globally. We have the EU having chosen those criteria. We have, for example, also the modern VAT countries, New Zealand and Australia. We have some countries where, at least at first sight, it's different. So, for example, we have the Gulf Cooperation countries, the 4 that have actually a VAT by now. So I think Bahrain, the Emirates, Saudi Arabia, and the 4th country, which I don't remember at the moment. And those 4, they have introduced use and enjoyment, so actual place of consumption. And as I just said, well, but that's normally not possible to determine that. And if we see what they then do, we find their approach is actually not different from what the EU and the modern VAT countries do. Because in the end, even if you say it's place of business and place of residence, we are talking about online supplies where the supplier usually doesn't know the customer personally. It's an anonymous or a pseudonymous environment. Plus, decisions on applicable VAT have to be made real time. And every additional click is something the consumer usually doesn't like. So you have to make a fast assessment of where the VAT should be due, to determine which VAT, of course, should apply from the business perspective. And that means you have to have proxies for the proxy of place of business or place of residence that make those more principal proxies, more basic proxies, actually operational for the business. And that is also what happens in the Gulf Cooperation countries, for example. So their use and enjoyment is then also specified for certain categories of supplies based on more concrete proxies. So we have the conceptual proxy, which is usually place of business, place of residence, which is then specified either also by law or by some implementing administrative circulars on how to actually determine those places. And the OECD guidelines here tell us, well, you should allow business to rely on data points and information that they collect anyways in the course of their business to keep compliance costs low. And these indicators should, on the one hand, be reasonably reliable. So they should give an indication of where the residence of the customers or the place of business. On the other hand, they shouldn't overburden business with having to collect a lot of information and store a lot of information. And so in the end, it's a trade-off between accuracy and efficiency. And I always like the 80-20 formula. We're not talking about anything perfect here. And as the presentation goes on, we're going to see very often we're not talking about anything perfect. We're talking about approximations that more often than not, and hopefully much more often than not, give us a good result, but that are not perfect. But still, those 80-20 solutions mean that neither the businesses nor the tax administration have disproportionate costs, compliance or administrative costs, and yet the results are still adequate. We get most of the revenue, we eliminate most of the distortions of competition, and so on. And if we were to have it perfect in the end, the perfect would be the enemy of the good, because the entire system wouldn't actually work, neither for businesses nor for the administration. So bottom line here, the proxy for determining whether a digital supply is connected to the territory of the country should be a place of business for businesses or place of residence for the customer. However, we need more concrete proxies that actually allow business to determine in an online environment where those places presumably are. And here we have the practice that has evolved from the EU and that has proliferated globally. So a lot of countries have picked that up. I mentioned 2 here, India and Australia, but many more too. The idea of the EU is that you build subcategories. So the basic rule is if you have such a digital supply, which the EU defines as an electronically supplied service, you look at different subcategories. So if this supply is delivered via an on the spot, so you can determine where it is delivered actually based on the nature of the specificities, the conditions, the circumstances of the supply, you go for that particular spot, and this is then the place of taxation. So if it is delivered via an identifiable Wi-Fi hotspot, it will be the place of the hotspot. If you receive streaming through a decoder necessarily, then it's going to be the place where the decoder is located, because this is presumably where you consume. If you receive certain services, late at night, what might that be, in your hotel room, it will be the location of the hotel that is presumed to be your residence. And there you see that, the conceptual proxy is just simply a conceptual one, not necessarily really that much relevant in practice, because a hotel would typically not be your place of residence unless you're really rich or something in your life went really wrong. But nevertheless, the EU regulations tell us if it's in a hotel, then this is your residence, presumably, and this is where the service, the electronic service, will be taxed. Or if it's transmitted via fixed landline, well, it's where the landline ends, and so forth. And if you don't have any of those more particular categories, then you need to rely on other proxies. And basically, the EU allows you to rely on either payment-related, mode of access-related, or residence-related proxies. So mode of payment-related would be your bank details. So if the credit card number you use reveals you're from Germany, well, this is an indication that your residence is Germany, because most Germans have a German credit card. That's the basic logic. If you access the service from a German IP address, the presumption is you will have a German residence. If you mention a German billing address to the supplier of the digital service, now, well, wouldn't know why you would need a billing address, but some might, especially businesses, then this would be an indication of your residence as well. And in the EU, you need two pieces of those evidences, which are information that the business typically has anyways. And if you have a turnover of less than 100,000 in the EU, you need only one of those pieces of evidence. Now, obviously, this is not always right. And this can even be manipulated. So my kids, when they want to watch, so my daughter, she's into South Korean movies, I don't know what, and Japanese movies. So what does she do? Well, she uses a VPN to access South Korean Netflix. In this case, it will not be the right place. But that's my daughter. I can do it so well. Plus, most people won't do that if we're talking about low value supplies, because it's too much of an effort. So in principle, we can assume that the IP will give us a reliable indication, even though it can be manipulated. Same for bank details. I can use my German credit card outside Germany too, of course, but most of the time I will be here. So it gives a reasonably reliable indication. And this is what I mean by 80-20. It's an 80-20 solution that can be refined over time as technology also advances. But for the time being, I think it's reasonably robust. When it comes to B2B, the proxy for place of business or the place of establishment where the supply is used will be which country issued your VAT registration or ID, and what is maybe the billing address. And as we shall see later on, this is also information that we need for the application of the reverse charge when it comes to collection mechanisms. So basically, these are proxies that have been copied a lot worldwide to make it operational for business in an online environment to determine automatically in split seconds what kind of VAT to charge and where then subsequently to declare and pay this VAT. Okay, now an associated question is, should we somehow limit the VAT on imports of digital supplies to only some categories of digital supplies? And you will see I'm against, but that's basically actually what we do here in the European Union. So we have rather narrowly defined electronically supplied services, which is the category of supplies that we tax at the residence of the consumer in a B2C scenario. So under the European definition, we have an electronically supplied service which attracts VAT in the country where the customer is presumably resident, only if it's rendered through the internet, plus it's essentially automated and needs only minimum human intervention. And this is a rather narrow definition because, for example, as I said, remote teaching is not covered, but also some other things are not covered, arguably. For example, if you think about gaming, if you have live casino online gaming, so you have online casino gaming, but it's live because there's a croupier throwing, this little thing in, then it's not minimal human intervention. Or if you're streaming a PEEP event, as we have some case law on in Europe, and this is why I think about such things, otherwise I wouldn't. And so if there's a PEEP show, an online PEEP show, and it's streamed, and you can actually interact with the, say, actresses, then it's not minimum human intervention anymore. And then it won't be taxed under the current rules in the respective country where the consumer is resident because it's not electronically supplied. So as you see, I jump directly to the problem. We have difficult delineation issues. Online gaming, if you do sports betting, well, someone's going to set the odds. Is that already relevant human intervention? I've argued so. In a legal opinion, I did, and successfully. Courts accepted it. But it doesn't really make much sense. You should tax that, of course, where the customer is according to the destination principle. The EU does not. Why? Well, that has some historical reasons. We basically did, as I said, a huge switch in the EU to the destination principle for services in 2008. And some member states didn't like that too much. The member states that had very low rates and which under the origin principle had attracted a lot of suppliers of online services. For example, Luxembourg. A lot of online services were supplied from Luxembourg into the rest of the EU under the origin principle. So Luxembourg didn't like the idea so much of shifting to the destination principle because they'd lose revenue, which is for one reason why we had the reform in 2008, but actually implemented it, so it took effect in 2015, 7 years later. Plus why we have a narrow definition of e-services. Some countries didn't like a broad one because, the narrower it is, the less destination principle under this logic, the less revenue those countries lose. So this is a peculiar situation, political horse trading in the EU that led to this insufficient definition. Yet others that don't have this kind of background were unfortunate enough to copy it because they thought it was maybe good practice without reflecting on the reasons why we have it in Europe. So India now has this definition. Argentina, to my knowledge, has it from what I saw. Norway has it. The Gulf cooperation countries that did the reform only a couple of years ago copied it. And it's really bad practice. It's better in terms of comprehensive coverage and therefore in terms of revenue, in terms of level playing field, in terms also of simplicity, no need for difficult delineations, to have a broad concept. So for example, supplies via the internet, as is the new definition since a couple of years in South Africa, which before had a very narrow list. And this could then be further specified for increased legal certainty through positive or negative lists. So have a basic broad definition and then go more into detail, exemplary, so illustrative only in positive and negative lists. We have those lists in Europe too, just based on a too narrow definition. But for example, they also exist in Singapore. Or you could just follow the OECD guidance and subject anything that is supplied remotely to a consumer to local VAT without any limitation to digitally supplied goods or services. And this is what de facto New Zealand and Australia do, because they just have the category supply of tangible goods, supply of movable tangible goods, supply of real estate, and then anything else. And if anything else, including digital supplies, is supplied to an Australian resident consumer, it's gonna be taxable in Australia. The place of taxation will be in Australia. And this is a good practice approach. Actually, it's what the OECD recommends. So bottom line here, don't use the EU narrow definition, which has a peculiar historical background that is not convincing conceptually. A broader definition is better. Well, now that we know when an import of digital supplies should lead to taxation in a particular jurisdiction, for example, Brazil, once it might have implemented its reform, the question then arises, how should we treat that? And here the first question, which I devote some time to because I've been made aware that it is an issue in Brazil, is should we necessarily have to treat that as a digital service? Meaning, is anything that is supplied as a digital supply remotely into a country automatically a service? And of course, that has ramifications in Brazil because there's the Imposto sobre Serviços or something like this at the municipal level, the ES. And the answer, in my view, is no, it doesn't have to be a digital service. Or from the perspective of municipalities, you can't claim that there is, the law of Moses saying whatever is supplied as a digital supply is a service, and therefore you get to tax it. And that's a political decision. If we just look at what's going on internationally, we see that indeed, it is predominant practice to treat this as a service. So I've listed a couple of countries here, from which I know they treat it as a service, and I don't claim to know what all 80 countries do that tax those imports. European Union, New Zealand, Norway, India, Russia, Argentina, the Gulf Cooperation countries, they treat it as a service. But why? Well, I know for sure in case of EU and New Zealand, it's a case of past dependency, and I would assume it's the same in other countries such as Norway, and the Gulf Cooperation countries just copied more or less what the EU did here. Past dependency meaning historically the situation has been that the supply of goods was clearly defined in the EU. It was as a supply of a tangible good for use as owner. And the point here is of a tangible good. And since we're talking about intangibles here, well, it couldn't be a supply of goods, and therefore it had to be a supply of service, because a service is defined for the purpose of EU VAT as anything that is not a supply of goods. So therefore, in the EU system, it's a supply of service, such as, for example, in the EU system, also the acquisition of a share in a company is a supply of a service, because we only have service and goods, and since a share in a company is not anything tangible, then it has to be a supply of a service. And therefore, also digital supplies are services, electronically supplied services in the EU, in New Zealand, and those other countries, in most countries in the world. However, that is not a given. For example, the OECD guidelines that I mentioned are very careful to say, well, it is services and intangibles that they're talking about. It's recommendations for the taxation of services and intangibles. And there's even a footnote in which it is mentioned that some countries do treat supply of digital products, say, as a supply of something different from a service, and that is totally fine for the OECD, and the guidelines apply nevertheless. And indeed, some countries can be identified that proceed as such. For example, as I just mentioned, Australia, there is no service classification. Anything that is not a supply of a movable tangible good or a real estate is anything else, and as such, it is taxable. New Zealand did that before 2005. It treated digital supplies as a supply of intangible good. Now they dropped that, possibly because according to the Oliver framework, digital supplies shouldn't be treated as supplies of goods, because supplies of goods usually clear customs, and that is not possible for intangible products. But before 2005, they treated it as intangible goods. And Canada and Indonesia still do that. So in Canada, they distinguish between a supply of intangible property, and that is most of what falls under digital supplies, or indeed a digital service. So if you download a software in Canada, that is the supply of intangible property. Whereas if you for a fee access, say, weather or stock exchange information, that would then be a digital service. But primarily you have to check whether it's a supply of intangible property. So there is a third category, tertium datur. And so what I mean to show is it's a question of what makes sense in a particular national context, whether you treat that as a service or as something else, or even as a supply of goods. It's a matter of expediency. It's not a dogma to have to treat it as a service. And so, for example, in Canada, the reason why they have this third category of supply of intangible personal property is that the Canadians feel, I'm not so optimistic, but obviously the Canadian legislator felt that in case of intangible personal property, for example, as the software license that you got through an online supply, it is possible to delineate where exactly in Canada, in which province this can be used based on the terms and conditions of your supply. And therefore, it is possible on this basis to be more accurate in the allocation of VAT at a subnational level, because Canada has a two-tiered system. They have the national VAT and then they have the subnational goods and services taxes. And at the subnational level, the Canadians obviously felt it can make sense to have this category of intangible personal property, because according to the license conditions, it might be easier to determine in which province this will be used, and therefore to allocate at the subnational level the taxing rights to this particular province. And so this is the reason why they do it. They don't do it because they feel, oh, services would be a bad category or this can never be a service. And they also don't do it because they felt, well, whatever intangibles always need to be treated differently. No, they did it for a particular policy reason. And the same would be true, I suppose, in Brazil. So, for example, if, well, services were, or the revenue from services continued to be allocated in a particular way, probably it won't, but if that were the case, then it would make sense to discuss whether something is a service or not. And if it doesn't have any meaning, well, then the question just simply doesn't matter. And in any ways, there is no guarantee that this has to be subject to a specific services tax. This is a question of, well, basically political compromise, in my view. Okay, that's all I'm going to say, because otherwise I think I say too much, and I shouldn't, because I'm not from your country. Should there be special treatment apart from the question we just discussed? Well, in general, probably not. So there are some countries that will impose higher rates on specifically imported digital supplies. I was surprised to see that Argentina, for example, does it. There is an additional impuesto país. So if you import a digital supply from a specific supplier, and there's a list of, I think, some close to 200 large suppliers of such digital supplies, then this is subject to this additional tax in addition to the regular VAT. Basically, probably because Brazil feels those companies make a lot of profit anyways, plus, they won't escape taxation, so why not tax them? And they actually have also a special way of levying it. I'm going to talk about that later on. And the question is that a good idea? And in my view, no. First, it's not neutral. It distorts competition between those some 200 companies that are covered, I think, and the rest. And apart from that, in any ways, it distorts competition between the imported digital supplies and the local digital supplies from local competitors. Plus, it might amount to a discrimination, de facto discrimination under the WTO rules, because I would imagine that predominantly it's US companies that are affected by this rate differentiation, or by this additional tax on top of the VAT with the same base as the VAT. And so I think in principle, no, this is not a good idea. On the other hand, we have the situation in the EU where we have a specific treatment for digital supplies, the electronically supplied services in the EU jargon, whereby they do not qualify for reduced rates, with the only exception being e-books introduced a couple of years ago. And the question is now, is that a good policy? Well, it's a trade-off essentially here, as the court has also highlighted in the case I've cited here, the RPO case. On the one hand, of course, it's clearly not neutral because you distinguish between different distribution channels. On the other hand, it can be more efficient and simple, especially for non-resident suppliers, because this relieves them from the burden of having to know all the different rates that apply in a country and to decide whether they are applicable for a particular category of supply, online supply or not. If you just apply the regular rate, all this delineation issues disappear, and this is a particular relief for non-established traders because they will be less familiar with the jurisdiction. So it's a trade-off here. So I wouldn't say it's necessarily bad. Of course, the elephant in the room is, as Rita, I'm sure, will share my opinion here. Why should we have so many reduced rates in the first place? Huh? So if we could, exclude also a few other categories of services from reduced rates, we would have much less issues. The tax structure would be much more efficient, and fairness could still be guaranteed, for example, through direct subsidies at a much lower cost. So basically, basic message, reduced rates are typically not a good idea, but we all know they're typically around anyways. And being pragmatic, we can say that, yes, it can nevertheless then be a good idea to differentiate here if you put a lot of emphasis on efficiency and simplicity. But in principle, my view is that there shouldn't be any special treatment for imported digital supplies, except differences that can be justified because of collection issues. So because in order to facilitate collection from a non-established supplier, you give some special treatment that is maybe then not neutral, but ensures that the tax can be actually collected, that it is efficient and compliance costs are not disproportionate. So for example, higher registration thresholds for non-established traders, because for them, compliance cost is much higher than for a local trader who is familiar with the system, with the language, with the procedures and so forth. Or to shift tax liability from the supplier to someone else, for example, a platform, as we shall see. This can be something that makes maybe more sense in a cross-border context, and therefore different treatment, even though it is not fully neutral, may be justified. But apart from that, apart from those collection aspects, I think it should be the same treatment as the neutrality principle dictates. So this brings us to the last point, tax collection, tax enforcement. Now, is that also an elephant in the room? Is that something all know is a big problem, but no one really wants to address? Well, maybe 5-6 years ago that would have been true, but I don't think it's anymore, because a lot has happened in that regard. We also have a lot of good practices. I wouldn't necessarily say already best practices. There's still room for improvement, but good practices to address the tax collection, tax enforcement issue. But maybe let's get a little bit academic and theoretical. First, me being an academic, so what is the root cause of our issues here? Well, basically, there's an E missing in the heading. It's territoriality of tax enforcement. It's public international law, or more precisely, customary public international law. And this dates back almost 100 years now. We have the famous Lotus case from the Permanent Court of International Justice, decided in 1927, where the court said, well, look, when it comes to extraterritorial jurisdiction, so a country wishing to make use of its sovereign powers in an extraterritorial context, there's very few limitations with respect to the so-called jurisdiction to prescribe, or also sometimes called substantive jurisdiction. So basically the jurisdiction to legislate on certain aspects. All you need is a genuine link to your country, be it a personal link. You are regulating the affairs of your own nationals, even though if they live abroad, be it a link to the territory, for example, because some activities going on the territory, or a foreign activity might affect the situation in the country's territory, or because basically you have some other connection, shares were issued in your territory and therefore you want to tax trade in those shares and so forth. So the threshold is really low generally, and also for taxation. Whereas the jurisdiction to enforce your legislation, including tax legislation, is strictly limited to the territory of each state, as a manifestation of the principle of sovereignty of states and non-interference in other states' territory. And that means tax inspectors won't be able to just simply go abroad, investigate there, collect the taxes there, enforce taxation there. This is not possible. Enforcement is limited to a country's own territory unless the other country voluntarily cooperates. And that, of course, then raises the question, if we usually have offshore suppliers, especially in smaller countries, now Brazil not necessarily being a smaller country, but maybe put differently, in countries that don't have so many local digital giants as China and the US have. China, of course, not having US not having a VAT anyways, but as markets where the large players at least supply digitally from outside their services, and of course also goods, but we're not talking about goods here. So how to effectively get a hold of those offshore suppliers to make them pay the tax? Should that be a pay as you wish? As some have claimed, the European system was more or less designed in its early stages when we started taxing non-resident third country suppliers on their digital supplies into the EU in 2003. Well, basically at the time it was more or less, because we had very few mechanisms in place to ensure compliance. But meanwhile, I'd say we have found good, as I said, practical solutions for both B2B and B2C, B to government usually being treated like B2B. They're different and they nevertheless both work B2B a bit better than B2C. For B2C, indeed, we do have an element of voluntary compliance to quite some degree, but it works for reasons which I'll explain. And to the extent that compliance is not occurring voluntarily, we do also have a stick. So there's really a carrot and stick approach here. And we'll have a look at why this works reasonably well, how it can be hardened, so a bit more stick, and what alternatives could be if you don't like this carrot and stick approach. Okay. First, we have the option of shifting the VAT liability to the customer, and the customer will be located in the territory if we use the standard proxies for destination, being either the place of establishment, the place of business in case of B2B supplies, or the place of residence of the customer in case of B2C supplies. So we will have a local customer, resident customer typically. And so we could just shift the VAT liability to that customer, and that would relieve the foreign supplier from all the compliance costs, or at least from most of the compliance costs associated with declaring VAT, remitting VAT, and so forth. But of course, it would also facilitate a lot the control by the tax authorities, and it would facilitate enforcement because they have a taxable person that is actually located on their territory. And this is indeed what is usually done in the B2B context. This is what the OECD always recommended since the Ottawa Framework Conditions, but also again in the 2016 OECD VAT GST guidelines. In B2B, there should be a reverse charge. So typically it should be the taxable person customer that is liable to pay the VAT. If it is a customer with a fully with a right to full input VAT deduction, obviously there will be actually zero VAT payment, because the tax liability can then be set off against the corresponding input VAT deduction. If the business customer is not entitled to an input VAT deduction, or at least not fully, then actually some tax revenue will be generated through the reverse charge mechanism. Principally, this works well, which is why almost all countries have adopted this approach, because, yeah, the local customer is already typically on the radar of the tax administration, subject to periodical audits, at least if it's a medium-sized large customer. And so it can well be known whether VAT declarations are made correctly. It can any VAT liability can be controlled for and enforced. Plus, those local customers in the majority have an incentive to declare VAT correctly, because they get the input VAT deduction anyways, most of them at least. There are some countries that don't proceed this way. For example, South Africa. South Africa requires a vendor collection also in a B2B context. So it's still the supplier of the digital supply that has to pay and remit the tax also when it's a B2B supply, but that is not standard practice. Most countries do the reverse charge. And so this is not really the problem. And this is, of course, however, also not where most of the revenue is at stake, because, as I said, usually the revenue effect is zero due to the input VAT deduction. So we're more interested in B2C when we're talking about effectively taxing digital supplies. And here, unfortunately, the approach is not feasible. At least this is what anybody with some experience in the field will tend to tell you. And this is also what the OECD guidelines say. So we can't have reverse charge for B2C. Well, basically, because on the one hand, compliance costs for the customer as a private customer would be disproportionate. Small amounts of consumption and a lot of paperwork or maybe electronic remittances and declarations for each customer, plus, of course, the control issue. No incentive to declare because no input VAT deduction. Why should they declare, and how do you want to control that as a tax administration, especially since we're talking about a lot of small scale transactions per individual, so totally disproportionate administrative costs, plus clear problems to monitor this adequately in any event, even if you were willing to invest. So this is just simply not feasible. Some have actually tried it. So South Africa did that until a couple of years ago. Nigeria did it until the end of last year. The Canadians actually still do it. They will change it 1st of July this year. Switzerland did it in the past, and they all abandoned it, or Canada's about to abandon it, because it just doesn't work. You don't generate any significant revenue if you try to collect the VAT directly from the consumer. There's countries that formally still try, like China. The customer, whether it's a business or a consumer, is supposed to withhold the VAT from the foreign supply, and obviously that's typically not occurring. So this is what you then read. It's of course not in the law. According to the law, in theory, the customer should pay the VAT. De facto, it's not happening. It's a very bad system in China, in particular, because there's a lot of legal uncertainty, because Chinese law also prescribes joint and several liability of the supplier. So in principle, it's the customer that should pay the VAT, but if your customer doesn't pay it, then you as a foreign business should pay it. And as in countries with a certain political system might often be the case, you never know. You might do well for a couple of years, and then for some reason, the government doesn't like you so much anymore, and they find out all of your customers didn't pay the VAT, and so all of a sudden you're at the hook, with fines, with penalties, and so forth. So really not a good model, but I just wanted to point it out. Some countries still do this approach. So basically try to collect VAT from the consumer, but definitely most of countries that tried that have abandoned it, and the smarter ones never even tried. It might be a different issue if we have total transparency of all online purchases of all individuals in a country being processed automatically by a central government entity. This is an academic proposal, which we'll discuss as a radical alternative at the end of my presentation. For the time being, we just have it in the back of our minds. And the bottom line is, on the conventional approach, you can't collect the VAT from the customer itself. That means we have a reverse charge typically for B2B. We don't have it for BTC. And a first implication of that is the supplier, and that's a disadvantage actually, and that's why maybe the South Africans do it differently. Supplier needs to verify and know the customer status, because you only get the reverse charge if your customer is a business, and you don't get it if the customer is a consumer. So that's, of course, a disadvantage of this approach. It's still pragmatic. The advantages, in my view, outweigh this disadvantage, but you have to make it operational again for businesses. You have to facilitate compliance, and that means there should be legal presumptions. That is best practice, I think, which allow a business to rely on certain indications again that they typically collect in the course of their business anyways, or that is not much additional effort to collect and maybe verify, such as a local VAT ID. This is the European approach, it's the Australian approach, it's the approach in, I think, many other jurisdictions, that if such a ID or tax number or Australian business number in this case is procured, then the supplier can assume that the customer is actually a business, reverse charge applies. And if it's not, then no such assumption applies. Again, it's not a perfect solution, because a private consumer might get hold of a business ID, or might even have one and use it for private purposes, which would, of course, be fraudulent, but maybe not so easy to detect, again, in an online environment where you're talking about real-time decisions having to be made. So unless you have a very strong IT system being placed at the disposal of each online supplier, so that a verification can be made online in terms of a few split seconds, or maybe a second at most, then you have a problem, because you can't really verify it. So again, you have to kind of assume that there will be no massive abuse, or maybe if there is a certain indicia that the customer is not a business, then you shouldn't rely on the VAT ID. For example, if you if you supply online porn, I mean, what kind of business would watch that? But again, we don't have a perfect solution here. We have an 80-20 solution, which in practice, however, reasonably works. And that it does work, I will show you in a few slides. So first implication here, a need to verify sometimes, and at least know or get some indication for customer status if you do this approach. Alternative is you don't do a reverse charge, you do a collection from the supplier, also in the B2B case, as South Africa does. Now for B2C, that means the supplier in principle still has to declare and remit the VAT. And what the OECD has recommended, and that has really had a lot of impact globally, is to at least then simplify this vendor collection through a simplified registration process. And this is what now 50 of those about 85 countries that tax imports of digital supplies do. They have this simplified vendor collection. It's what we have in the EU, Australia, New Zealand, South Africa, Switzerland, Norway, Russia, Indonesia, and so forth. Actually, the EU set the standard here a little bit. We were the pioneers when we expanded the MOS, the mini one-stop shop, in 2015, permitting simplified registration in one jurisdiction in the EU to discharge of all declaration and payment obligations related to the supply of digital electronic services into the EU. Now, not all countries do this. Some obviously want to learn the hard way. So Nigeria, having abandoned the idea of taxing its own consumers, now indeed does a vendor collection, but a classical one. So they require foreign online suppliers to actually register in a paper process in Nigeria. I wonder how successful they will be in doing this. I could imagine that 1 year onwards, you know, every year the learning curve gets a bit steeper, they might move to simplified vendor collection as well. So bottom line here, not all countries do it as yet, but it's best practice and also predominant practice to have a simplified vendor collection. Now, what does that mean? Well, the idea is make compliance as easy as possible, because you know you can't enforce so well. So ideally, there is no much need for enforcement, because most businesses comply voluntarily, and we will see in a few seconds that actually kind of works. And you want to then make it easy for them to comply, so to increase the percentage of those that do. And it's elements like being able to register online only in English language, with an English language assistance in case you have questions, to have longer filing periods that also correspond to accounting periods of businesses, typically, for example, 3 months, to have no invoicing for B2C supplies, or if you do require invoicing, at least admit the invoicing standards of the country of origin and not of your own country, so it's much easier for the supplier. There is then no need for a local tax representative or agent, which is, of course, a very costly institution for any business. So basically, to have all these elements to make compliance as smooth and as little complex as possible, also to require as little information as possible from the business. Some countries just need 6 data points that you need to submit every 3 months. And finally, of course, the downside is then you also don't get an input VAT credit, because in this kind of simplified system, the tax administration doesn't get the information it needs to really verify whether and to what extent you should actually be entitled to such an input VAT credit. So if you have a significant input VAT in the country of destination, you should then go for the regular registration, which is typically the optional alternative to the simplified registration. But in case of digital supplies, that's usually not much of a problem, because most of those companies supplying digitally into a particular jurisdiction don't incur so much local input VAT. And the good news is in 2021, so just a couple of months ago, the IMF actually found that in the countries that it surveyed, which were Australia, New Zealand, Norway, and Singapore, there is actually a high level of voluntary compliance. So the large majority of businesses supplying digitally into a country do comply when there is simplified vendor collection, as is in all those 4 countries. Now, I also show you a few statistics from the EU to also solidify this observation a little bit. So the EU experience is that they do collect quite a bit through this simplified vendor collection mechanism. There's actually 2 of them in the EU, one for traders established inside the EU, supplying into other EU countries where they don't have a physical representation. And here we see in the entire EU, there's some 4 billion euro being collected in 2018. So clearly quite a bit more than in 2015 when this first started. Similar trends I wrote down here we have in Norway and Indonesia. So clearly this is picking up, also because, of course, the number of supplies is increasing. As I said, it's a growing sector of the economy. And we have the same experience more or less when it comes to non-established suppliers, so suppliers from outside the EU. There is a little drop in 2017. The EU Commission explained this by the fact that seemingly some large players, so I don't know, maybe whatever, and Netflix or others, they opened up an establishment inside the EU, probably in Ireland, and therefore they switched from the non-union scheme to the union scheme, and therefore they're not caught in this statistic anymore, they're caught in the other statistic. But if you take that together, that's some altogether 4.5 billion, a little more, that's being collected in 2018, which is what we have the latest figures for. And that is, as I said, significant, together with a little bit that is collected in the regular registration process. We're talking about, as I said, 0.5% of all VAT revenues of the EU. And this is the number of registrations. You see a really high number, slowly increasing over the years since 2015, of businesses intra-EU registering under the simplified vendor collection scheme, and also an slowly increasing number of offshore non-EU traders. However, this number of offshore traders is much lower. Now, does that mean the system actually doesn't work so well, contrary to the IMF experience based on Norway, Singapore, and so on? Does the EU show that the system doesn't work so well because the numbers for the third country suppliers are so low? At first sight, this might be the case because, of course, inside the EU, we have much more intense administrative cooperation. There is much more exchange of information. There is much more cooperation when it comes, at least on paper, to the collection of tax abroad. So you could think this acts as a deterrent for intra-EU businesses, and they register therefore, whereas offshore businesses know not much can happen and they don't register. That could be an explanation. And in some cases, this will be the explanation. So clearly there is some level of non-compliance. We don't know exactly how much, but the EU says there are certain schemes. They have uncovered certain fraudulent behavior by traders. They said so in an impact assessment from 2018 for an amendment of the VAT directive. They found some streaming schemes. They found some online gaming schemes where VAT was not correctly paid in the EU, not correctly declared via the simplified vendor registration. And so there is obviously some VAT gap here. So voluntary compliance doesn't lead to 100% compliance, obviously. On the other hand, there is further explanations that show that probably in the EU too, the system is working reasonably well, although not perfect. And of course, in the EU, as we shall see, it could still be improved, especially in the EU. Because there's two other explanations. A lot of, especially the large players, will have an establishment inside the EU, and so therefore they fall under the union scheme again. And also because a lot of the smaller players from outside the EU will offer their services via a platform. And as we shall see in hopefully a few minutes, because I just realized I don't have so much more time, and we want to discuss a little bit, there is a platform scheme whereby it's the platform that is deemed as the supplier, and therefore the platform registered instead of those smaller suppliers using the platform. So this is why the numbers are a bit distorted here. And the numbers are actually still higher than, for example, they are in, I think, Singapore and New Zealand, where there are in the 500,000, I think, offshore suppliers having registered. Okay, so why does it actually work reasonably well, arguably? And how can we still make it better? Well, the main reason is that the way our economy now looks like, especially in the online sector, is we have a lot of monopolies, oligopolies. We have a lot of concentration there, and that means also revenues are concentrated in a small number of very large businesses. So Australia has done the math, and they found out that the top 30 taxpayers are taxable for supplying digital supplies in the sense of online services or online supplies of intangibles into Australia, made up for 85% of revenues. And those large businesses that make up the bulk of the potential revenue tend to comply. Why? Because on the one hand, they have a high reputation risk in case they don't. So even if you can't enforce much, it might tarnish their reputation. And the public is much more sensitive to this than it was maybe 10 years ago. Plus, they have the means to do so. They have their in-house specialists. They deal with those VAT issues also on a global scale. And so for them, it's a cost, it's a nuisance, but it's quite manageable. And basically, they want to comply and they can comply. Plus, of course, since they're so large, they're much more visible to the tax administration. They won't be able to, supply into a country below the radar of the tax administration for reasons which we'll come to in a couple of slides. How can tax administration actually detect non-compliance behavior? And since they're so large, they typically can't evade being detected if they should not comply. And they also know this, and this is also a reason why they tend to comply. And then most countries that have the simplified vendor regime also have for the smaller suppliers a registration threshold, so they they don't fall under the destination principle. They're not required to declare and pay VAT for their online supplies. Of course, this is then not fully neutral, but it is a pragmatic, efficient solution. You have some figures here in New Zealand, and I all converted this into US dollar. 40,000 US dollars threshold, Australia 60, South Africa 70, India only 14. Maybe India should have the 70, but yeah, well, who knows. Anyways, these are significant thresholds. The EU doesn't have any threshold, and this is one of the reasons why I say we could improve our system, because it's just not reasonable to expect that someone who from the Bahamas is supplying a few, say, gaming or other kind of online services into the EU would declare these supplies. It's just too much of a cost. The risk of detection and enforcement is just too low. So we should be pragmatic in the EU as well and have a threshold. At the moment, we only have a small threshold of 10,000 euros for intra-EU supply of digital electronic services, but we don't have anything from outside the EU. So clearly, this is deficiency in the EU. It makes sense to have these thresholds, and they are quite common globally. Plus, it also works, and it works especially well in countries that have been proactive in communicating this system, especially again to the larger taxpayers that account for the bulk of revenue. This is what Australia did. This is what Norway did. This is also what seemingly Singapore did. At least that's what the IMF says. This is also what the EU tried in 2014. Approach your taxpayers. So the EU staged huge events, for example, in the United States to make everybody familiar about the simplified vendor collection. Australia drew up a list of 2,000 potential suppliers of digital supplies into Australia, and each of them got a letter from the Australian Treasury. Look, this is going to be the new system. You might be caught. Please be aware of that. Please adapt. So they were very proactive, and that clearly was part of the success story. And then, of course, business will always tell you, and correctly so, you need to give business some time to adapt to a new environment. So if you introduce this kind of system, there should be some lead-in time. Business usually wants a lot of time. OECD recommendation, IMF recommendation is at least 6 months to allow them to adapt their IT systems. Plus, and this is really crucial, you can make this much more efficient if you involve the large marketplaces, the large electronic platforms, through which a lot of traffic, a lot of those digital supplies is being supplied, the platform typically then acting as an intermediary. So Google Play, for example, or whatever is the equivalent with the iPhone. And there you see I have an Android. I don't know what the equivalent is. Just to give an example, app stores. Here, if you make those platform operators the deemed supplier, that has huge advantages, a few disadvantages, but huge advantages in principle. What does it mean? It means you treat the platform rather than the actual supplier as the one that supplies B2C, and therefore as the one that has to register under simplified vendor registration and the one that has to actually remit and pay the VAT. Whereas the supply by the actual so-called underlying supplier is treated as a supply B2B to the platform, which is then typically zero-rated, so the supplier still gets the input VAT credit, but no VAT needs to be collected because the platform would have an input VAT deduction anyways. And so by this system, you make the platform, instead of the underlying supplier, liable and responsible to remit, declare the VAT in the country of destination. And that has the advantage, first of all, again, higher levels of compliance and control, because we're talking about large entities here that have the means, that have the will typically, and if they don't, it's easier to detect that they don't comply. It also makes the thresholds that you should have less relevant, because the threshold, of course, then applies at the platform level, and the platform will always be above the threshold, or almost always. And so you don't have so much distortion of competition from the threshold, because most of the smaller players that would normally fall under the threshold and not pay VAT for their supplies are caught by the rule whereby the platform is the supplier, and therefore the platform does actually pay the VAT. So the negatives, the downsides of the thresholds are minimized And finally, we have an efficiency gain because compliance costs, as we well know, are regressive. So if we take them away from the small suppliers and we put the compliance costs on the platform, we gain in overall terms. Of course, seemingly then for the platform, from the platform perspective, they have higher compliance costs, but they can just increase the fee for the underlying suppliers a little bit, and that increase in fees will be much less than the compliance costs that those underlying suppliers had if they faithfully complied. So because of these three big benefits, this is something that has been rapidly picked up. We have it in the EU since 10 years. It's a so-called commissionaire model, but it's essentially bottom line also in deemed supplier model. And we now also have it in Australia, New Zealand, South Africa, Russia, even in Canada in a week or so. So this is rapidly proliferating. The question that, of course, each country has to decide is whether to have that only for non-resident underlying suppliers or for all suppliers. For all suppliers is, of course, something that enhances neutrality, that makes life easier for the platform operator that need not know where the supplier is actually resident. The downside is, and of course it's non-discriminatory. It does maybe also have a WTO aspect. The downside is that sometimes, you might then, if the platform operator is operating from outside your territory, you might shift the tax liabilities to someone who's outside from someone who's inside, namely your local small suppliers using the platform. So this is why each jurisdiction has to decide whether to limit this to non-resident underlying suppliers or to apply it generally to all suppliers using a marketplace. The alternative, if you don't want to make the platform liable, which is usually the case when the platform has a good lobby in your jurisdiction, because otherwise there's really no reason why not to do this. The alternative is that the platform could at least record the information on the underlying suppliers and report it periodically to tax authorities so that tax authorities can then try to track non-compliant small suppliers that are nevertheless above the threshold that hopefully exists. And as to the details of how to implement this, because there are some tricky issues, there is really great guidance, I think, I find in the 2019 OECD report on the role of platforms in the collection of VAT, GST on online supply. So there's a 2019 report, and all the relevant issues are addressed here. It's really a great report. Last slide when it comes to actual practice, and then the very last slide is an academic slide, more or less, again, halfway. Still, there will be some non-compliant people around. And what can we do about them? So how to give some tease to this simplified vendor collection? Well, of course, you need to identify who is non-compliant. And there's actually quite a few ways you can do that if you are a bit innovative as a country. And you don't even have to be so innovative because there's a lot of best practices around. So a good idea is reach out to competitors. You know who's compliant because they comply with you. Ask them who of their competitors is not. They will probably tell you because they have a disadvantage. And then all of a sudden, all those competitors also complied because they have been detected. Then you ask them who else is not complying. So this can be really very efficient. And according to the IMF, wasn't specified, so I can't tell you any countries. Quite a few countries do that. Countries such as Norway or Australia, in addition, check publicly available information. For example, automatically pretending to be buyers and trying to buy an online supply from some supplier to see whether someone is actually complying or not, or running even AI through patterns that they detect in terms of payment or email traffic. This is something New Zealand seemingly does, to see whether there's someone non-complying. You can reach out to other jurisdictions. This is something New Zealand tries. I don't know with whom, probably Australia, I guess, and see who's registered there and why not at your place. Probably they supply to you too. And so then you can address them and say, look, are you actually complying? Shouldn't you maybe declare something? And then there's third-party data that's quite promising. It's something the EU will do as of 24. We have a directive enacted last year, which will come into effect in 2024. As of then, payment service providers, banks, credit card companies, and so forth, which at the moment handle 90% of payments in the EU, at least, for online supplies will be obliged to record cross-border payments if they hit a certain threshold, more than 25 payment transactions per supplier per 3 months, and transmit that to other member states, which will transmit it into a central European database, and there a European agency will try to detect whether those who seemingly supply into the EU for online supplies actually pay VAT, declare VAT and pay VAT, and they will notify member states if certain companies don't. So use the payment service providers data to detect non-compliance patterns. And some member states actually do it already. They didn't wait for a directive. Finland seemingly does. And according to what they claim, they collected an additional 0.1% of VAT revenue just by checking a payment service provider data, cross-checking it, and then initiating enforcement procedures against non-compliant providers of online services. Yeah, well, how then to deal with those non-compliant traders once you have identified them? There we have some weaknesses. They might then comply once you confront them. That's what everybody hopes for. But if they don't, you either need administrative cooperation or other kinds of sanctions. It's not that we don't have any administrative cooperation in the field. We have some special agreements, very few, according to which countries have pledged to assist each other in exchange of information and collection of VAT. The EU has concluded such an agreement, for example, with Norway, and Norway with the EU, of course. We have the same based on regular treaties, which often, when it comes to exchange of information and assistance with collection of tax, don't just cover direct taxes, but also cover indirect taxes. That's something not to be forgotten. And so you can base your requests on those regular treaties as well. The only problem is the US, which is where a lot of those suppliers sit, because since the US doesn't have a VAT, they usually don't agree to this in their treaties. So that's a bit of a problem, but otherwise it works. And you can do things like joint audits. So try to get those foreigners audited in their home country using cooperation with the home country jurisdiction. Of course, you only do that in the large cases. Otherwise, it's not efficient. Based on regular instruments such as the OECD, Council of Europe, Multilateral Convention. Something that might hurt even more and quicker is you can require third parties, such as payment service providers, to interrupt the business of those non-compliant companies, for example, by disallowing them to process any payments to such companies. And at least the larger players will find that so threatening to their business model that they will then comply, typically. Of course, you can say all of this is not enough. It's maybe not 80-20, it's maybe 90-10, but I want to have the 100, and this is going to be the final slide. And I guess I'm a bit over time, but yeah. Anyways, it's the final slide. So what Argentina does, quite interestingly, they have, from what I saw, a financial intermediary withholding tax. So they just don't only collect data from financial intermediaries, they require them to collect the tax. And they do so for a designated list of, as I said, some 200 companies seemingly that are known to the Argentinian authorities to supply to a significant extent digital supplies into Argentina. And if a payment is made via one of the covered payment service providers, so banks, credit card, and so forth, this payment service provider is required to withhold the VAT portion that is applicable and pay it directly to the Argentinian government. So a split payment system declared a withholding tax under the Argentinian system. The problem is, in my view, that this is not neutral, especially since the alternative, if either the supplier is not on the list or the consumer uses another method of payment, is that it should still be the consumer that is liable. And this is the worst of all, options you have, as we've heard, because the consumer will never pay the VAT. And that means de facto no VAT on anything else. And so there's a strong incentive for the consumer to either buy from someone else, or maybe even buy locally, or to buy using other payment methods that are not covered by this legislation. For example, Digital currencies, of course, not much in use yet, but on the rise. Or maybe intermediate payment service providers not covered, maybe PayPal, I don't know, others. Nevertheless, I find this interesting. If the fallback rule were a bit more robust, so if the fallback rule were not, well, then the consumer has to pay her or himself, that's not going to work. But if the fallback rule is, well, if it's not the financial intermediary that withholds, then it's still the platform that needs to pay, or it's the supplier itself that needs to pay under a simplified vendor regime, then this could be something interesting to make sure that for the large ones where you know they supply into your jurisdiction, you really get the money fast and for sure. And for everybody else, you still have a pretty robust system. That is something maybe to consider. Finally, I should mention at least one academic alternative by our colleague Marie Lemen. She suggests tax geofencing. What does that mean? Yeah, well, it means that there should be a virtual fence around your country, and whenever a payment goes out for an online supply, you register that as a government and you tax that. How is that gonna work? Well, the idea is that every citizen should have an IVAT number, so an individual VAT number. And the citizen should then pair that with his or her bank account. So they should go through their bank and say, look, I have this IVAT, please link this to my account. And if they have 5 accounts and 2 credit cards, they should link it to all 7. And then once they use these methods of payment, the payment service provider will link their transaction data to this IVAT, and they will forward the entire data to a government portal. And there the government can see, okay, so and so much money was paid for this kind of transaction, and therefore so and so much VAT is owed. And also the citizen can access that portal, see how much VAT he or she actually owes, and every 3 months or so, they should then pay it via the portal. Now, first of all, that's quite a compliance cost for the ordinary consumer, but maybe that's acceptable if it's easy to access this portal. But the real issue, of course, is that there will be some loopholes. If you look at digital currencies, for example, alternative digital currencies, it doesn't work to that extent. And then the big issue, in my view, is data protection. So the government will know every single kind of consumption you did based on your payment transactions. You can read so much out of consumption patterns. You can know a person better than herself. I always like this story about a father getting upset with a large US supermarket chain because they send advertisement for pregnant women to his daughter of minor age and saying, how can you do this, giving her bad ideas. Turned out she was pregnant, and the supermarket knew, dad didn't, because the supermarket knew her consumption pattern. Do we want government to know all of this about us? I personally don't, and I feel I don't do so many bad things, but still I would prefer government wouldn't. So I think this is a big issue here. Okay, this is it. Sorry, I might have exploited and abused your patience, but I hope you found it at least partially interesting. Thanks a lot.
Professor, completamente interessante. Acho que tem um grande aprendizado, uma grande utilidade para nós que estamos trabalhando com essa penumbra da ideia da tributação na economia digital aqui no Brasil e copiando modelos ultrapassados, como sua palestra destacou, da Europa. Eu queria passar imediatamente para a professora Rita da Feria, que vai precisar sair logo na sequência, depois o professor Isaías Coelho, para a Melina Rocha consolidar as perguntas, fazer suas observações e para a gente ter o fechamento com o professor. Professora Rita, por favor.
Hi, Joachim. I have to leave in a couple of minutes, so I give you my first comment. So, of course, there's so much that I would like to discuss a little bit more with you. This is no surprise. I think the issue of the higher rates for digital services is something that our friend Eduardo is pushing, and maybe you and I should have a conversation. I think we think the same way about this. But I want to focus just 3 points, to highlight 3 points before I go, that I think are pertinent for the Brazilian tax reform. So the first one is that I think it is very clear from your presentation that basically we have thought all this through. So there is this myth in Brazil that that VAT is an old tax that cannot apply to digital supplies. This is a pure myth. We have thought this through. We have come to a broad agreement on the broad guidelines of what should be done. And I think your presentation highlighted this very well. I also use the sentence often that you just used in your presentation, which is you don't need to invent the wheel. So this has been thought through. The second point I wanted to mention was the issue of the European model. I often say that Europe is not a model for anyone because I'm referring often to the base. And on that, as you know, we have very strong deficiencies. However, on this area of digital supplies, I think it's fair to say that Europe has, by and large, led the way. And in the areas that we have drawbacks still on the system is to do with path dependency. So if we were installing it from new, I think the European system could broadly serve as a model, but with some tweaks that don't pay service to path dependency. So I think that it's a good model for the Brazilian reform. And the third and my final point is something that I know that is very controversial in Brazil, but I know that you and I also think in the same way, which is about principle-based drafting. And I think what you highlighted as regards design of proxies, it's very much in line with my thinking as well, is you have a broad principle of taxation. You can have lists afterwards that are examples of how to apply either positive lists or negative lists, but principle-based drafting is the way to go. It is the way to draft tax legislation now. And there is no point going back to the 1960s way of drafting tax law. So I think these were my three comments that I think are pertinent. I'm not sure how aware you are of the discussions in Brazil, so I think I would highlight these 3 points as very pertinent for the Brazilian tax discussion. I'm sorry to have to leave now. I'll message you privately, and thank you so much on my behalf. The others will do their own thank yous, but on my behalf, thank you so much for coming. It was just great to have you. Okay.
Thanks a lot, Rita.
Beijinhos a todos.
Professor Isaías Coelho, por favor.
Thanks, Eurico. Welcome, Professor English. What's a pleasure to have you here. And we learned a lot in your presentation, very relevant for the present discussion in Brazil. Of course, some of the topics that you raised, we need to digest. It will take some time, but that's what we are doing right now in our country. I would like to add one question to those who Melina is going to do next, is the following. There are some kind of accrual of value which doesn't take a form of payment, specifically the cession of a personal information in a quid pro quo with the provision of some services. I wonder if some thought has been given to how to reach to those kind of provisions. Okay. Well, since we don't have much time now, without much ado, I pass the word to Melina Rocha, that's going to capture those questions that have been submitted by our audience and add her on. Thank you very much for staying with us today.
Professor Joaquim, your presentation was amazing, and Rita was totally right when she said that you are the best person to talk about this. And just my comments are the same as Rita did, like many people in Brazil, including our Supreme Court, thought and think that the definition of supply of intangibles as service is something intrinsically related to VAT model. So your presentation, you show exactly that's the tax policy option. We have other options in other countries. So your explanation on the history of European model and these path dependency issues, the European context is very, very helpful and important to us. So thank you very much. Another comment I have in the line of what Rita said is about proxies, because they are important not only for determine if the supply was made inside or outside the country, as you explained, for importation determination, but also in federal countries like Brazil, because we will have if we implement a VAT system, we have different rates across the states, more or less like here in Canada, we have different rates across the province. So this will be an issue to Brazil as well. For instance, here in Canada, as an example, we have, for example, some situations where some suppliers are locating customers through IP, and the customer is located exactly in the border of two provinces. So they are having difficulties to determine the correct location. So we have some kinds of issues. It's not like a big issue, but inside the federal country, this should be a problem more or less. And we have one question from audience, from our friend Rodrigo Frota. He's asking how relevant in terms of revenues is the collection of VAT on digital supplies in European countries, if you have some data, some numbers, or only in Germany. So thank you very much again, Professor. It was very, very good, your presentation.
Well, thank you very much, everybody, for these really kind words. I'm terribly sorry I really took so much time for it, but yeah, I didn't really look so much at the watch. Anyways, yeah, to address the questions. So I think the first question from my distinguished colleague, Professor Coelho, was, has there been some thought given to these, if you like, barter transactions? So you receive a seemingly free digital supply, but in turn, you allow access to your personal data. So the typical search engine model, for example, or free-to-play games where they, however, take your data and so forth. Yes, this has been intensely discussed in Europe, I'd say 3-4 years ago. There was a lot of debate on that. And in the end, tax administrations decided they do not want to tax this based on the current rules. I personally, from my academic position, tend to agree, but I should also say it's very much disputed among academics what the correct approach would be based on the current system. I have two objections, so I agree with tax administrations here regarding taxation under the current system. First of all, we have a big valuation issue. How do you want to evaluate these personal data being well allowed to access by those free online services suppliers? You would have to assume that a data point has an inherent specific value, but OECD surveys, for example, from 2013, there's been a big survey tell us that there is no such thing as a given value of a certain data point. So it always depends on context. How much other data do you have? For what purpose do you use it? So there's maybe a range, but you can't really pinpoint it to a particular value. And then you might say, as the European system usually does, well, if you have a barter transaction and the supplier can't really know so well what the value is of what the supplier gets, then take the cost of the supplier as the basis for VAT. The problem is we're talking about online supplies where the marginal cost is almost zero. You know, for Google, it doesn't matter whether a user uses Google one more time. So again, we don't have anything here. And the second point is, a bit more fundamentally, we don't really have consumer expenditure in my view, because the consumer is not giving anything away. He or she is not giving his or her data away. The data still stays with him or her. It's just the company gets to use it, but that comes at no cost really for the consumer. So I'm a bit skeptical also, because VAT should be something on consumer expenditure, not just on consumption in my view. But again, that's also disputed. And there is no real consumer expenditure here. The consumer, in my view, doesn't give anything away that should be burdened, that indicates ability to pay, if you like. So for those two reasons, I'm opposed. Tax administrations, for the valuation reason, also don't want it. But if you had a special regime, if as a legislator you designed a special regime with certain broad assumptions on how to evaluate those transactions, you might be able to justify it. And then the question regarding the revenue, well, as I said, in terms of what is collected, and since there's some non-compliance, potential revenue is probably higher. But in terms of what is collected, we're talking about 0.5% of the entire VAT revenue of the European Union. Of course, it's a bit different depending on each member state, because some member states have huge imports of digital supplies, such as, for example, Eastern European countries, whereas some others, Italy and others, have relatively little. But on average, it's 0.5% of overall revenues, and overall revenues are, I think, 1.2 trillion. Yeah, so again, we're talking about 5-6 billion in absolute figures for the EU.
Muito obrigado, professor Joachim, agradeço muito a sua exposição, vai ser muito útil no Brasil, nós estamos no meio desse debate e a sua fala rompeu mitos em relação à tributação digital. Então, agradeço também a Melina Rocha, ao professor Isaías Coelho, à professora Rita da Feria, e com isso nós encerramos nosso evento de hoje, já deixando o professor Joachim Melina convidado para o nosso próximo evento no ano que vem, não é? Quando já estiver pronta a reforma tributária, mostrando os resultados e o quanto foi impactante essa apresentação de hoje. Muito obrigado, professor Joachim.
Muito obrigado.
Professor, bye-bye. Thank you.